Okay. So 3.5 is the last chapter in determination of globe income. And 3.5 speaks about PE and flow through allocations. Okay. So what was 3.1? 3.1 was basically, we discussed that it's a subset of accounting standards. For determining the scope in one chapter one, for to see if you are more than 750 million, you have to look at the consolidated financial statements. For calculating globe income, also, the first part is financial accounting net income or loss, or it's abbreviated as FANIL, FANIL. Okay, that's the starting step. So, chap 3.1 was about which which accounting standard to use, because constituent entities are spread across the globe, and which accounting standard to use in each case. Yes or no? Chapter 3.2 is after you determine which panel to use, what are the mandatory adjustments? There were 9 mandatory adjustments and one option, which was stock based compensation option. It was optional whether you can take or whether you need not to take. And we learned about stock based compensation in 3.3. 3.4 was about shipping income exclusions. So, you had to find out which is qualifying shipping income, which is ancillary shipping income, and, which does not is unqualified or non-qualified shipping income, which does not get any exemption from globe income. We discussed in 3.4, and 3.5 is about PE and flow through allocation. So, this is the last adjustment. So after the whole idea is after completing this chapter, you will be able to allocate globe income between main entities and permanent establishments, apply the correct treatment for flow through entities, including tax transparent structures and reverse hybrids, and explain the overarching goals of Article 3. Now, basically, what do we mean here? Like, what is that, we are trying to achieve by this adjustment? Let's just take a moment to understand PE and flow through allocations. Okay. So we have permanent establishments, right? We have permanent establishments. What is a permanent establishment? There are numerous way in which permanent establishments could be defined. Like, there is as per the treaty, as per the domestic law, right? Or something called as deemed PE. So there are a lot of ways in which a PE can be identified. Now, in pillar two, before that, PE is what? PE is just an extension of the parent, correct? It's just an arm of the parent, right? Parent or HO for that matter. This is an LLC, or which has a separate legal standing. Does PE have a separate legal standing? Answer is no. It is just an arm of its head office, right? It does not have a legal standing of its own. Even if you register for corporate tax, you have to register this person, not the PE. If you are opening a bank account, etc., you are opening for this person and not for the PE. So there are, like, plenty of, this is not a separate legal entity. But for pillar two, uh, should we see if both of them together, give 15%? Both of them together, 15%, or should we kind of look at, how do we satisfy the 15% test? Both of them together 15%, or each of them 15%? What did we discuss in chapter 1? For avoidance of doubt, let's assume that this is in UAE and the PE is in, let's say, Germany. Okay. Now, since both are having, this is just an extension of the HO in another country. Should I see it in one way, or should I kind of see it separately? So I'm getting answers. So just now says separate, Ashik says separate. Yes, you have to see it separately. Okay, definitely you have to see separately. So there should be, this HO should be earning 15%. I mean, should be kind of like, having an effective tax of 15%. And this PE should be having 15% effective tax separately. And, this would have to be paid to Germany. Yes or no? Yeah. But there is a little problem here. Now you see, uh, okay. So how would the HO's income be computed? So let's say that this is HO's income. How would that be computed? HO's taxable income. How would it be computed? It would have its standalone family, correct? Plus the PE's profit and loss would also be there. If I am making a financial statement for HO, okay, would I include only HO standalone income, or it would be consolidated with HO and P? How would it be? Would I have to consolidate, or would I only have to put HO's income? What happens in the financial statements of HO? I'll repeat my question till I get an answer. So in the financial statement of HO, this being an LLC, would I consolidate both of these, or would I only put standalone FANIL of HO? You will definitely consolidate, because see, both are same. It's not two different people. There is no consolidation as per IFRS 10 happening here. This is not a subsidiary. This is a PE. This is nothing but you only. Okay, so you would consolidate. Now, what happens in the PE? What happens in the PE? PE would report only standalone income of PE, correct? In its financial statements, right? Now, wouldn't that create a double counting? Is the whole question, because same income, only look at the PE's income. PE's income is taxed here, PE's income is taxed here also, or my panel would include PE's income also. So wouldn't this PE's income, if we are treating PE as a separate entity, if I'm treating PE as a same as HO, and it would be only liable as together, then it is fine. Right. But since Pillar 2 rules specifically say that PE is separate and HO is separate, don't you think there should be some adjustments in HO's account to reduce, or PE's and HO's account to reduce this double counting? Yes or no? So that is the context we are. Now let's come into taxation. So this is just P&L. This is just accounting statements. Okay. Now what happens in taxation? What happens in taxation? How would I find the tax of PE? What would be the tax of PE? How would you calculate the tax of PE, and how would you calculate the tax of HO? Yes. Tell me, how would you calculate the tax? So how we calculate the taxes? I expected this answer from all of you. But let's say that I will not take the standalone income of PE as prepared for financial accounting. I will now calculate what is the income attributable to P. What is the difference between standalone income and income attributable to PE? Let's say that this HO in UAE is having a customer in Germany, and PE is doing all the sales, everything, but the invoicing is going from HO. Okay, in such a scenario, since invoicing is going from HO and not PE, would it be there in the standalone income of PE or in the standalone income of HO? It may be there in HO's books, right? Correct. But is that income attributable to PE because PE is doing all the work? So we have to do what we call as functional and factual approach. Functionally, who is earning that income? If it is PE, then that income has to be attributable to PE. And we use something called authorized OECD approach, AOA, to split from the consolidated financial statement or the combined financial statement. We will split what is the income attributable to P. Yes. And on that, we will be paying taxes on this income. Income includes both. Okay. It is income and expenses. So after that, we will pay tax on whatever is the profit. Right. What will happen here? This is how we do for PE. Yes or no? How will we do the same for HO? HO would also have to pay tax on the full, okay, both income. Even if it is attributable to PE, I will pay on full. I will either get a credit for the taxes which I pay in the PE's jurisdiction, or in sometimes, like UAE corporate tax allows it, I can exempt PE income completely from my books. Yes or no, Article 25? Right? So my tax payable, would be reduced by either I'll get a credit or I will just, exempt the income that I'm attributable to P. This is how the taxation works. Yes or no? Any doubts there? Okay, fantastic. Now the whole context of our discussion is, since there is double counting and all, how will I kind of do this? How will I separate this in terms of this is how corporate taxes or international taxation works, but how will I do it for pillar two? How will I kind of like PE should be separately assessed at 15%, HO separately 15%? How does it work out? Okay. So this is the whole context. This is the first part of P. Are we ready to go and delve into that? What pillar two says now, or are you clear? What is the whole problem, whole dichotomy of issues? Okay, because there is double counting. So how would I kind of make it single count? So what the article says is that yeah. So Globe Framework's jurisdictional blending approach works smoothly when entity is distinct legal person. Correct. If it is subsidiary, then it's fine. I mean, everywhere, wherever you are, 15% is fine. Reality is messier. Multinational groups operate through PEs that have no separate legal identity but are taxed as if they did. Okay, and through partnerships and other vehicles that different countries classify differently for tax purposes. So whenever there is a PE, things become a little messier. It won't be like separately we can find out what is 15% because there is double counting happening between both. So without these allocation rules, which you are going to learn, the framework would double count income, miss it entirely, or attribute it to the wrong jurisdiction. So that is why Articles 3.4 and 3.5 provide the machinery to ensure every euro of globe income lands in exactly one jurisdiction for ETR. There is no double counting. There is no complete miss of things as well. Okay. So this is what it is. So why are special allocation rules needed? You see, permanent established meaning Ps are treated as separate constituent entities for pillar 2 purposes, but they may not have separate financial accounts. Okay, flow through entities. We'll learn about flow through and reverse hybrids later. Let's first concentrate on P's. Okay, flow through also the same problem. provide allocation. So 3.4 and 3.5 provides allocation. So how do we allocate? What in case if there is PE as a constituent entity, how do we allocate pillar? That's what we are learning. Okay. Now for group purposes, PE is treated as a separate constituent entity located in the jurisdiction where it operates. Each PE has its own globe income, covered taxes, ETR calculation, and potential top-up taxes. So, how do we compute all of this? So, for its purpose, what they are doing is you have to first categorize PE into a particular type. Okay, there are four types of PE which are given. You have to identify which type it is. First type is treaty PE. What is treaty PE? So, then let's say that in this example there is a treaty between UAE and Germany. Okay, and in that treaty it says this particular setup here is a P. Then it becomes a treaty P as per the treaty. So PE under applicable tax treaty between main entity jurisdiction and PE jurisdiction. That's called a treaty P. Then what is domestic law PE? PE under the domestic law of PE jurisdiction. Let's assume that there is no treaty between these two, but Germany's domestic law says, okay, based on the setup, this is a P. Okay, that's called a domestic law P. It's not a treaty P, rather it is defined by the domestic laws in Germany. Understanding it? Yeah. Deemed P. Now let's say that domestic law says that it is not a P. There is no treaty between these two countries also. But you have to see OECD model convention. Model convention, not the signed one, the agreement, the format. So in the model convention, if this setup is a PE, as per Article 5 of the model convention, which says PE, if this is a PE, then also it's called a deemed P. Would be PE under OECD model, even if PE jurisdiction did not have a treaty with the main entity jurisdiction. Okay, even if there is no treaty, there is no domestic tax, interference in defining it as a PE. But if the OECD convention kind of says, then yes, it is then also a P. Okay. Then there is stateless P. When none of the above applies, then it's called a stateless P. Okay. This would be more useful elsewhere, not now, but I'm just kind of like keeping it there so that we understand. Did you understand what is the four types of PE? Any doubts there? So now what they have the beauty of this is by defining four types of PE, none of them will escape it, right? Now whatever is not in one, two, or three will be four, right? So all kinds of PE setups can now be called in a name. It's either a treaty PE, it's a domestic law PE, it's a deemed PE, or a stateless PE. Okay, this would be more important while covering covered taxes, while calculating covered taxes, but this is just the definition of it. Now, okay, the four-tier definition ensures comprehensive coverage. If any framework creates PE status or if the resident simply exempt income, no income rules apply. Now, what should you do? What should be the step by step in allocating PE? So, first one is determine PE's financial accounting net income. So, determine PE's FANIL. Okay, determine PE's FANIL. So, use PE's separate financial accounts if they exist. If no accounts exist, prepare a notional standalone accounts using UPE's accounting standard. So, first thing you have to do is prepare a separate P&L for P that is needed for pillar. Okay, how to allocate PE? First thing is you have to make a separate P&L and find out the financial accounting net income or loss. Now, once you find that, adjust to reflect attributable amounts. So once you find this, now you include adjust it to reflect attributable amount. So PE's income must reflect only the amounts attributable to PE. So that they might be having a standalone, but now you have to make it into what is attributable as per the techniques you already know, authorized OECD approach or functional and factual approach, all that. Yes. So you have to look at head office's books also and find what is attributable to the PE. So in the standalone, you will add income attributable or if standalone has income attributable to HO, then you have to deduct it and just adjust so that income attributable to PE is adjusted onto your financial accounting net income or loss. Is that clear? Step two? Yes or no? Yeah. Now they are also given the attribution basis. So if there is it's a treaty PE, then what is the attribution as per applicable tax treaty? You have to take it. Okay. If it is a domestic law PE, then what is the attribution as per the domestic law? If it is a deemed PE, then as per Article 7 of the OECD Model Convention. Okay. Using these means, you have to find what is the income attributable to PE and adjust with the financial accounting net income or loss. Is that clear? Okay. This is step number two. Now, what you should do? Now, once you kind of find out what is the income attributable to P, you adjust the standalone, you deduct this income from the standalone panel of the H. Okay. So P income not included in the main entity. So excluding P income from the main entity. Okay. So if whatever is the income that you find, you deduct it from the H. Clear? Yes. So PE, what is attributable here? HO would only have that minus what is attributable to P. So now things are separate. Globe income is truly separate now. Yes or no? Okay. Now things are a little bit different if it is a loss. Okay. Now if it is a loss, now if it is an income, then you can straight away deduct it from the HO's books. But if it is a loss, if income attributable to PE is a loss, then there is a PE loss push down technique. I'll tell you why it is done also. So, if PE loss is treated as an expense for domestic tax purposes in the main entity's jurisdiction. So, PE loss is deducted from the main entity's jurisdiction uh, is as an expense for the main entity. PE's globe loss for the year would be zero. Okay. Main entity's globe income is reduced by the loss. Future PE profits are treated as main entity's income under the losses capture. Okay. Now, what they're trying to do is, let's say that if it is an income, you just so what am I trying to do? So I have the HO and I have the P. Okay, so this is P. So what are we doing in HO now? HO has consolidated, or let's name this as HO. HO has consolidated panel, correct? And PE has what? PE has standalone PE panel. Okay. What is the first adjustment? You have to find the income attributable. So you have to adjust, add or minus, like, the income attributable to P. Okay. So once you adjust, all that, what you get is you get the taxable income of P. Correct? Yes or no? Now, what you have to do is, since it is consolidated and this already has, you have to reduce taxable income of P. So, what you will get? You will get the, or let's say that this is the globe income of, this is the globe income of P. How will you do the attribution? It depends on the TPE type. If it is a treaty PE, as per how the attribution should be as defined in the treaty. If it's a domestic PE, then it should be as per what the domestic tax rules say. If it is a deemed PE, as per Article 7 of the OECD model, you have to attribute and you have to reduce this from the PE from the panel so that you will get the globe income of each. Yes or no? Correct? Now this is simple. Now let's say that this is a loss case. Okay, in case of a loss, what happens is, let's say this is a loss. Okay. Oh my God. So let's say that this is loss. Now what you will do? If it is a loss, you can't carry forward anything or something. You will what? You will kind of negate the loss. Okay. So basically your globe income for that year would be what? Okay. Your globe income will not be negative. Rather, PE will always have a zero thing. Now what happens to HO? HO, what you have to do is you can deduct the PE's loss. Okay. So net will be the globe income. Why is it done? Why is, because again there would be double counting, right? So if I have a loss, I'll get a benefit here. I'll get a benefit here also, since I am adjusting the PE's loss accordingly. So in order to avoid that, what they're saying is benefit would only be in the HO, only in one place, not in both places. Now subsequently, what happens is, let's say I have a loss, right? So subsequently, what happens is, let's say that in the next year I have profit. So let's say my loss was, let's say, uh, you dollar 25K. Okay. So here also I will deduct loss of 25K, and I'll have zero here. I have negative 25 here. Now next year, let's say it is let's say it is 20K is my profit. What will happen? You again what will happen here is, you will again, like to the extent of the loss, you will not kind of have any. So what was the previous year loss? 25K. So next year if you have 20K profit, adjust 20K loss. Okay, and what you will have is zero. What you will have the next year is also zero, and here you will add 20K. In the next year, whatever is still, you will add 20K. Now, in the subsequent year, let's say it is 10K, I have only 5K remaining. 5K would be my income and 5K would be adjusted here. So, this is how things will go. Okay. So, to the extent of loss which is given to the HO, I would again keep adjusting till, if it is more, then only I will kind of like, put it as my income. Is that clear? This is same like your, revaluation loss. readjusted to the extent of revaluation gain. You adjust there, and balance would be coming into P&L. You remember all that IA 16, same thing. So that there is no double counting of losses, you will no not have any globe income in PE. If it is a loss, all the losses would be adjusted here. But subsequently, if you get a profit, that profit would be added here. Here it is again going to be a loss case. Okay, to the extent of that. So that is what this is saying. PE loss is treated as an expense of the main entity. Okay, it's treated as an expense of the main entity. PE's globe loss for the year would be zero. Main entity's globe income is reduced by loss. Future PE profits are treated as main entity's income until the losses recapture. Okay, so why they are doing it is to avoid double counting of losses in both jurisdictions. They are putting everything only in one jurisdiction. Okay, this is called loss pushdown. So, are you okay? Did you understand this? So, the mechanism prevents groups benefiting twice. One by reducing domestic tax through PE loss deduction, and again by retaining a globe loss in PE jurisdiction that might shield future profits. Okay. So, why they are doing it is because if I, instead of zero, let's say that I'm keeping it as a loss, next year's loss would be adjusted here. Here I already gave that loss, so it would result in double counting. So this can carry forward and set off later. This would get a huge loss deduction in the first year, so it would be double counting. So in order to avoid that, we are keeping it only here. We are literally adjusting its need or its right to kind of have a future sheet or a loss carry forward in the later. We are kind of reducing PE for that. So this is basically why they have given a PE loss push function. Is it clear? It may be a little technical, but I think you can understand all this because okay. Now this is what is PE. So what did we do in PE? What is that you have to understand in PE? PE, you have to first make the standalone income of PE. You know what is the problem is, right? Because there would be two. So in order to kind of capture it only at one place, either here or here, what do? We first make the standalone income of PE, financial accounting net income or loss of the PE, then adjust it to income attributable to PE. Okay, whatever is the income attributable to PE, you will reduce from this to get the globe income. Yes. Okay. If it is a loss, then there is a loss pushdown mechanism. Here, the loss will not be allowed to carry forward. This will be made at zero, but the expense could be recorded here. Okay, fantastic. So that is PE. Now let's understand flow through entity. Now this is one doubt that everybody is having. If you understood PE's problem well, you could understand flow through entity well. Now, what is a flow through entity? What is a flow through entity? Flow through entity is something which does not have a, like for example, for the purpose of taxation, even if I earn like, so much of income, say 100K of income, I will not pay this entity. Let's say this is ALLC. Okay. ALLP. This ALLP will not pay the tax on 100K, rather, it would be paid by its owners in their ratio. So it would be paid by, let's say that, Mr. A and Mr. B in the ratio of their shareholding. So let's say if it is 50-50, then both of them would have to pay taxes on 50K each. Yes, this is what is called a flow through entity. It's a flow through entity for tax. It's also called a transparent entity. Yeah, am I audible? So this is called a flow through entity or a transparent entity. Can you give me some examples? Unincorporated partnerships, foundations, if you choose, right? Even unincorporated partnership, it's an option. We can choose to be a transparent or opaque, but default, I would be transparent. Correct? Oh, so this is what is a flow through entity. Again, flow through entity also has a problem. So same problem that we see in PEs is that, hey, who will actually pay? So you, if I have 15%, uh, globe income also, should I pay the globe income or would I? Again, since I am a flow through entity, it would be paid by these two. Who will pay? Same transparency applies to me for globe also. So I will not put a globe return and all. These guys will. Hmm? Or I will not put the globe bill, 15% bill. I will not be doing. These guys will be doing. Is it going to be transparent in globe also, or is it going to be opaque in globe? What do you think? Did you understand the context of what we are trying to explain here? Who will foot the bill? I am a tax transparent entity. So would it apply for pillar two also? Who would foot the bill in case of flow through entity? So let's understand. Let's understand that. So what does pillar two says about flow through entity? So what they have done effectively is they have defined two types of flow through entities. Okay. So there are two types of flow through entity. First type is called first type is called, what is that, fully transparent. So let's go here. So there is, you know what is flow through entity, right? Entity that is fiscally transparent in its jurisdiction of creation. Okay, it's a fiscally transparent entity. Now there are two types of flow through entities. One is tax transparent flow through entity and opaque entity, or what is it called? Reverse hybrid entity or opaque or opaque. Now, what happens is, what is the difference between these two? It could, a flow through entity could be a tax transparent entity or a reverse hybrid entity. Now, what does it mean? Tax parent transparent means, so let's say that the this flow through entity is in UAE. Okay, flow through entity is in UAE, and these guys are in. Uh, so this guy, let's say that both are in the same jurisdiction. So this guy is in India, or both of them are in India. Okay, and this is a transparent, this is a transparent entity registered in UAE. Now, UAE treats this entity as transparent, but does India treat this entity as transparent? I'll refine the question one more time. Let's say it is an LLP which is, incorporated in DIFC. It's a DIFC foundation. Let's and in UAE, in the local tax jurisdiction, I have claimed it to be a transparent entity. Okay, I have chosen the transparent entity option. So I am a transparent entity in UAE. No question about that. Okay. But what you have to understand is this foundation does all its operations in India, buying and selling real estate in India, in New Delhi, in Bangalore, in Chennai. So that's what is happening. So in such a scenario, it is taxable in India also, right? Yeah. It's taxable in India also. So India treats this as what? Treats this as opaque. India partnerships and partners are different. Partnership is a separate taxable entity. Okay. So that is called, it is transparent in its jurisdiction, but in the jurisdiction of its owners, it is opaque. That's called a reverse hybrid entity. It is opaque here, but here it is kind of like transparent. So if it is opaque here and if it is transparent here also, that's also a reverse hybrid or an opaque entity. It is opaque in one jurisdiction. Okay. Now, what is a tax transparent flow through entity? That means this entity is regarded as a tax transparent entity in UAE as well as in the jurisdiction of its owners. If both of them treat it as transparent, then it is a tax transparent flow through entity. If either of them is saying no, 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 we will not tax, we will not let this guy, these two pay, you only have to pay, you are the taxable person. If any one jurisdiction takes it as a opaque or takes it as a separate taxable person, then it's called a reverse hybrid entity. Are you understanding? Yeah. Two types of flow through entities. Hmm? So you have to identify whether it is you have to identify when you get a flow through entity, you have to identify whether it is a tax transparent entity or a reverse hybrid entity. Okay. Now, because the allocation is different for both. Okay. So now we'll read tax transparent entity, flow through entity that is also treated as transparent by its owner's jurisdiction. That's called a fully tax transparent. Here also, there also, it is transparent. Reverse hybrid is flow through entities that is treated as opaque by its owner's jurisdiction. Then it is a reverse hybrid entity. Okay. Or an opaque entity, non-transparent. Are you understanding what I'm trying to say? The context. Now, in such a scenario, who will pay the taxes? Whether the opaque entity should pay or tax transparent entity should pay. Let's see. So if it is a tax transparent entity, if you are, if you kind of noted that it's a tax transparent entity, it's transparent for the, both the jurisdictions, then globe income and cover taxes are allocated to the constituent entity owners in the proportion of their ownership. So in such a case, this guy will not, if let's say this is a tax transparent entity, then it just kind of goes into these two. Pillar 2 also. So this is a loophole, guys. See, pillar 2 would only kind of be applicable if it is a constituent entity, correct? Now, let's say if I have a tax transparent entity and if I am owned by two individuals, do you think that pillar 2 has to be paid by them? No, because this is not a constituent entity, this is an individual. So if it is a tax transparent entity, this guy will not be applicable for pillar 2. These two would have to show that they are paying 15% tax for their respective share, which will not come unless these two are also companies or like having a separate taxability. If it is individuals, it will not come. Okay. But if it is an opaque entity, if it is a reverse hybrid entity, globe income and cover taxes remain at entity level. You only have to pay 15%. You only have to check whether your ETR is 15%, then you have to pay the tax. Okay. So you, whenever there is a flow through entity as an MNE in your when there is a flow through entity as a constituent entity in your MNE group, then you have to first check whether it is a tax transparent entity or whether it is a reverse hybrid entity. What happens if it is tax transparent? This guy will not pay. These two will have to assess if they are having 15% ETR. Okay. So whether the 50% profit that they're deriving from this is subject to 15% ETR or not, they have to do. But if it's a reverse hybrid, no splitting, no nothing, you only would have to come and foot the bill. Is this clear? Okay. So if you are having a DIFC foundation, which is a flow through entity, and if it is owned by individuals, then the case is very much not there because they will not tax individuals. It's only for constituent entities. But let's say that it is an reverse hybrid or an opaque entity where in the owner's jurisdiction, owners are in India, and India would definitely treat it as an opaque entity. Then in such a scenario, DIFC Foundation should also foot the bill. Okay, they are also a separate legal entity for the purpose of Pillar 2. All this transparency would work. Okay. See, there could be chances when UP itself is a flow through entity. The ultimate parent entity is a foundation. Then same practice above is followed. You have to see whether it's a transparent entity or a reverse hybrid entity. Okay. Yeah. Yep. So that's it. So it's pretty simple. You know how to allocate PE's income, right? PE's income, just find what is the income attributable as per the attribution applicable based on the type of PE this is, and then reduce it from this to calculate the globe income of this guy. Now, if it is a loss, then what you have to do? Then you have to push down. Here, if it is a PE loss, then the loss should be zero, and it would be the loss would be given as an exemption to the parent's income. How do we know if the owners are opaque? Now you have to see which jurisdiction the owners are resident, and based on that, what does that jurisdiction? How does it tax these transparent entities? Whether it's opaque or whether it is, say for example, let's say there is a foundation which is owned by Ashik and I. Okay, we both are Indian tax residents. Now we are UAE tax residents, so it is fine. But let's say that I am both, I am an Indian tax resident. So in such a scenario, what would happen is, this becomes a reverse hybrid entity, and this would be a standalone. Now Melvin is asking, what if one owner is UAE, one owner is India? See, you have to understand that 50% of it becomes a hybrid, and 50% of it could become a tax transparent. But in general cases, what happens is they will not allow this. If even one of them is in a reverse hybrid situation, then you have to pay taxes on your own. But theoretically, this is what will happen. 50% is exempted because it's a tax transparent entity. Another 50%, what happens is you have to pay as a reverse hybrid entity. The PE or the flow through entity would have to pick up the bill for that 50%. Okay. Okay, I'm getting more questions. Okay. Right. So how PE and how flow through entities are decided or like regarded in terms of allocation of globe income is the final chapter. This is a very technical chapter. If you could only understand if you're very clear with how PE allocations work in practice. Okay. So any doubts in this, we can take up, separately, parallelly. But I think the whole notion, the context of having these two articles, 3.4 and 3.5, is this. In case of, to reduce double counting in types of PE, and who would put the bill in terms of a flow through it. Okay. So let's close for today. Yeah. Thank you, guys.